If we answer quickly, speculation means taking a position in commodity or any financial asset without having cash position or physical commodity itself on the basis of price movement. But traditionally, let's look at the types of traders, hedgers and speculators. Hedgers generally do have cash position or physical assets, and speculators do not. But if you look at their activity in futures markets, now the distinction between hedging and speculation is very blurry. Consider hedgers. Sometimes they do have physical assets, but they have price expectation. They do not hedge against the price risk. Should we consider this position, not taking any position, as speculative position? Yes, of course. Basically, by not taking any action against the price risk, they are speculating because they have some price expectation. They are speculating. On the other hand, speculators, we have traditional speculators, day trader or long term. They have some price expectation for the future, and they use some of the information from the physical market. Then they take position, either short position or long position. On the other hand, there are scalpers or market makers. They do not have any price expectation. They trade within a second, and without any price expectation. They buy very in the hope that they buy low price and sell at a high price. This high price, I mean percent of a cent, but they do take a lot of position, 100,000, like consider high frequency traders. These are speculators basically, but hedging and speculation is not clear for the time being. Of course, we know what is speculation. You are taking a position without having any exposure to physical assets, and in the hope that you make profits. But it is not clear yet who is speculator, who is hedgers. Why speculators? Speculation is a bad word. It's an ugly word. Politicians, especially during the 2008 financial crisis, looked at something to blame. They cannot blame themselves because they are making the policy like subsidies, like export restriction. These are all causing price to increase. And also we have to think about rising demand and flat oil supply. These are the main reasons why we saw most of the commodities prices to rise initially, but they cannot say these things because they are part responsible for those. So we have this ugly word, speculation. Maybe we should not call speculation anymore. We should call investment in a commodity that is scarce. That's the investment, true investments. Anyway. As I said, as I was answering to your first question, I do not believe speculators have any effect on fundamentals or prices. Basically, the speculators, when they participate in the market, the decision to buy or sell based on the information they are getting from physical market itself. But this information sometimes are very noisy because we don't have information about inventories in non-OECD countries or something, and then this information is noisy. They make their decision based on imperfect information. Once, but they realize this information is wrong or not entirely true, they reevaluate their expectation and they change behavior. They might, let's say, affect the prices during the trading day, but I don't think they have any effect on what's called prices. So I don't think they change the what you call fundamentals of oil or other commodities. First, we need to look at what happened in 2008. I mean, July of 2008, we saw the peak oil price at 147. I'm talking about, of course, WTI. And by December of 2008, July of 2008, by December 2008, oil price dropped to $33 or something. But the problem over there, we saw Lehman crash. Basically, people start panicking what's going to happen, and we enter in a recession. Then demand basically collapse, of course, price collapse. But what we realized later on, this collapse is part undershooting of oil prices, because other commodities, of course, the prices decline not as much as oil, and oil prices recovered by April of 2009 to $60. Basically, we can say that $30 or something is undershooting over there. It is not exactly a rational response to recession in the first place. Then we come to 2009, middle of 2009, demand start to recover, and people realize also some of the initial reaction is not rational, and demand start to recover. 2010 is demand recovery, and of course prices start to rise during that period. And we come to 2010, 2011, we all see Arab uprising and all the oil supply disruption from Libya, or then it started Syria, and now we are dealing with what you call Iran. Basically, we really don't know what's going to be happening. I believe 2012 is going to be also supply side problem. And for the price, $100, I am, of course, OPEC members always announce some kind of fair price. Their fair price is about $80 to $100. They might be happy with this one, but I'm not sure whether this price level stays at this level, because we have this uncertainty over supply, and also uncertainty on health of European economy and all the other problems. I'm not sure whether oil is going to stay here at $100. I'm not sure what you mean by oil price stability, because if we look at 3 months periods, WTI, in October oil price was 75, now it is $100. Can we call this stable? I do not think it is stable. For the last month, yes, it is around $100, but I don't call oil prices stable at all, especially with the intraday volatility is very high currently. And also, I do not believe that we have the forecasting tools available, better forecasting tool available, because we are missing a lot of information from the physical market, like inventory data, like consumption in China or something, like supply, like reserves. And if we don't have these information, better information, or information from financial markets, who are the participants and everything, I do not think that we can forecast prices for the longer term. And longer term, I mean, I don't mean longer term beyond 3 months. I'm talking about within 3 months. It is also difficult. Let alone after 3 months, it's almost impossible to forecast prices.